Can AI beat the market? Or is that just hype? AI can write emails. AI can summarize reports. AI can help plan a project, organize a schedule, explain complicated topics, and turn a messy pile of notes into something that actually makes sense. But now people are asking a much more dangerous question. Can AI beat the market? And maybe more importantly, should you trust AI with your money? Because that's where everything changes. It's one thing to let AI help you rewrite an email. It's another thing to let it anywhere near your savings, your retirement account, your investment research, or the money you worked years to build. And right now, the internet is full of people acting like artificial intelligence is about to become the world's greatest investor. AI stock pickers, AI trading bots, AI market predictions, AI portfolios, AI tools that claim they can find the next big opportunity before regular people even know what's happening. And you can see why people are interested, because if someone tells you there's a machine that can read more data than you, react faster than you, never sleep, never get emotional, and maybe spot patterns humans miss, that sounds pretty tempting, especially if you're watching a chart go up. But here's the problem. A chart going up for a little while does not automatically mean intelligence. Sometimes it means skill, sometimes it means luck, sometimes it means a short time window, sometimes it means risk that hasn't shown up yet, and sometimes it means somebody made a very exciting thumbnail. Welcome back to Build Smarter. Today we're opening the room on AI and investing, not to give financial advice, not to tell you what to buy, not to tell you what to sell, and definitely not to pretend AI is some magic money machine. This video is a reality check. By the end, you'll have a clearer way to think about AI investing hype, trading bots, stock picking claims, and the difference between using AI as a research tool and treating it like a financial genius. Because AI may be useful, it may help you learn faster, it may help you understand terms, compare ideas, summarize information, and ask better questions. But when real money is involved, the question is not, can AI sound confident? The question is, should I trust it? Let's start with the thing nobody likes to admit. The stock market is hard, not because every single idea is impossible to understand, but because markets are messy. They are driven by earnings, interest rates, inflation, debt, jobs, government policy, consumer behavior, global events, investor psychology, fear, greed, rumors, expectations, and 1,000 other things happening at the same time. And sometimes, the market moves for reasons that only seem obvious after it already happened. That's why investing can make smart people look foolish. It's also why a short-term win can be very misleading. A person can make money on a trade and still be wrong. A person can lose money on a trade and still have made a reasonable decision. Because investing is not just about what happened once, it's about process, risk, time, discipline, costs, taxes, drawdowns, emotions, and whether the result can hold up over time. That's where AI investing claims get slippery, because if an AI model makes money for 2 weeks, people may want to say, look, AI beat the market. But did it? Or did it just get lucky during a specific window? Was the market trending in a way that happened to fit its strategy? Did it take big risks that looked smart only because they worked at that time? Did it trade less and avoid fees? Did 1 or 2 lucky moves carry the entire result? Would it still work in a down market? Would it still work after 6 months? Would it still work after a year? Would it still work if thousands of people started copying the same strategy? That's the boring part, but it's also the important part, because a flashy result is not the same thing as a reliable system. And this is where AI can trick people, not because it is evil, but because it sounds confident. AI is very good at sounding like it knows what it's talking about. It can explain things in a smooth voice. It can write a clean summary. It can make a complicated topic sound simple. It can give you a list of reasons why something might go up, why something might go down, and why it might stay exactly where it is. And if you're not careful, that can feel like wisdom. But confidence is not the same as accuracy. And a beautiful explanation is not the same as a good investment decision. That matters, because money has a way of making people want certainty. Nobody wants to hear, maybe. Nobody wants to hear, it depends. Nobody wants to hear, this might work, but the risk is higher than you think. People want the answer, they want the pick, they want the signal, they want the machine to say, buy this, sell that, and don't worry. But that's where things get dangerous. AI can help organize research, but don't hand it your money like it's a responsible adult. Treat it more like a raccoon with a calculator. Interesting, maybe clever, surprisingly fast with numbers, but still not someone you leave alone with your wallet. That's the line. Useful tool? Maybe. Financial adult in the room? Absolutely not. Now, to be fair, AI is not useless in investing. That would be the wrong takeaway. There are real ways AI can help regular people think more clearly. For example, AI can explain financial terms in plain English. If you hear words like price-to-earnings ratio, dividend yield, market cap, expense ratio, volatility, or dollar cost averaging, AI can help translate that into normal human language. That's useful. AI can summarize long articles, earnings calls, annual reports, and financial news. That can save time. AI can compare different investment ideas and help you understand the pros and cons. That can be useful. AI can help you create questions to ask a financial advisor. That can be very useful. AI can help you notice when you may be acting emotionally. For example, if you paste in your own reasoning and say, "Am I making assumptions here?" it might help you slow down. That can be useful too. AI can even help build a checklist. Something like, what is the risk? What is the time horizon? What information am I missing? Am I chasing hype? Am I reacting to fear? What would make this decision wrong? Those are good questions. And if AI helps you ask better questions, that's a win. But there's a huge difference between using AI to support your thinking and using AI to replace your thinking. That's where people get into trouble. Because the market punishes overconfidence. It punishes people who think they found a shortcut. It punishes people who mistake a backtest for a guarantee. It punishes people who forget that every strategy looks better before reality punches it in the mouth. And yes, AI can make that worse. Because if a human gives you bad financial advice, at least you might hear hesitation in their voice. AI does not always hesitate. It can be wrong in a very polished way. It can be outdated. It can misunderstand your question. It can miss context. It can hallucinate. It can make assumptions you never noticed. And if you ask the wrong question, it may confidently answer the wrong problem. That's not something you want to control your money. There's another issue too. Markets are competitive. If a strategy truly works, people rush toward it. And the more people use the same advantage, the smaller that advantage usually gets. That's not just an AI problem, that's a market problem. If everyone discovers the same shortcut, it stops being a shortcut. So, when someone says, "This AI found a winning strategy," the next question should be, would it still work if everyone had it? Would it still work after fees? Would it still work after taxes? Would it still work when conditions change? Would it still work when the easy opportunity disappears? Because markets adapt. People adapt. Algorithms adapt. And the edge gets crowded. That's why we should be careful with the idea that one AI model is suddenly going to make everyone rich. If everyone wins, who loses? If everyone uses the same tool, how does the tool keep an advantage? If the opportunity is obvious enough for everyone to see, is it still an opportunity? These are the kinds of questions that slow down hype, and slowing down hype is good, especially with money. Now there's another fear people have. What if big institutions use AI better than everyone else? That's a real concern. Large financial firms already use advanced data, algorithms, models, and automation. This is not brand new. AI did not suddenly introduce computers to Wall Street. Wall Street has been using technology for a long time. The difference now is that AI tools are becoming easier for regular people to access. That can be helpful. It may let more people understand information that used to feel locked behind jargon. But it does not mean regular people suddenly have the same advantage as billion-dollar firms with proprietary data, teams of quants, direct market access, legal departments, and massive computing resources. That's important. AI can level some parts of the playing field, but it does not magically make everyone equal. It can make research more accessible. It can make education easier. It can help you understand what you're reading. But that is not the same as beating professional trading firms at their own game. And that's where a lot of content online gets a little too cute. They take a real thing. AI can help with research, then stretch it into a fantasy. AI can make you rich. No, nope, absolutely not where we're going. This channel is not here to sell fantasy. We're here to build smarter. And building smarter means knowing what a tool can do, what it cannot do, and where it can get you hurt. So, let's separate this clearly. What AI can help with, it can help explain. It can help summarize. It can help compare. It can help organize. It can help brainstorm questions. It can help you spot gaps in your thinking. It can help turn confusing financial language into something more understandable. What AI should not do. It should not blindly pick stocks for you. It should not replace a qualified financial professional. It should not make decisions with money you cannot afford to lose. It should not talk you into taking risks you don't understand. It should not become your excuse to stop thinking. And it definitely should not be treated like a magic machine that prints money because someone online showed a green chart. That green chart might be interesting. It might be worth studying. But it is not a life plan. One of the easiest ways to get fooled in investing is to confuse a result with a repeatable process. Imagine 10 people flip coins for 2 weeks. Somebody is going to look like a genius. They might get heads again and again. They might even start explaining their coin flipping strategy. They might say they understood the wind, the wrist angle, the room temperature, and the psychology of the coin, but maybe they just got lucky. Now replace those people with AI models. Same problem. If enough models are making trades, somebody is going to win over a short period. That does not automatically prove the winner has a long-term edge. It might. But you need more evidence. You need longer testing. You need different market conditions. You need to understand the risk. You need to know the drawdown. You need to know the costs. You need to know whether the strategy survives when it stops being new. That's why the best answer to can AI beat the market is not a simple yes or no. The better answer is, sometimes AI might help find useful patterns. Sometimes it might improve research. Sometimes it might support professional systems. Sometimes it might look brilliant and then fall apart. And sometimes it might just be lucky. That's the honest answer. Less exciting than AI will make you rich, but it is much more useful. Now, let's talk about regular people, because that's who this matters for. Most people watching a video like this are not trying to build a hedge fund. They're trying to make better decisions. They're trying not to be left behind. They're trying to understand whether AI is something they should use, avoid, or be nervous about. And my answer is this. Use AI to learn. Use it to prepare. Use it to ask better questions. Use it to make complicated topics less intimidating, but keep your hands on the wheel. If you're making serious financial decisions, talk to qualified professionals. Understand your own risk. Know your time horizon. Be careful with anything that sounds too certain, and remember that a tool that can explain investing is not automatically qualified to manage your future. That's the line, because there's a difference between, help me understand this, and, tell me where to put my money. The first one can be useful. The second one can be dangerous, and that's true even when the answer sounds smart, especially when the answer sounds smart. That's one of the biggest dangers of AI. It can make weak ideas look polished. It can make guesses look official. It can make uncertainty sound confident. And when money is involved, that can become expensive very quickly. So should you be afraid of AI in investing? I don't think fear is the right word. You should be aware. You should be skeptical. You should be curious. You should be careful. You should understand that AI is going to affect finance, markets, research, scams, customer service, investment platforms, and the way people talk about money online. That part is real, but you should also resist the urge to treat every AI investing claim like a prophecy. The future isn't that simple. Markets aren't that simple. Money is not that simple. And AI isn't magic. It is a tool, a powerful tool, a strange tool, a tool that can help and mislead in the same afternoon. So, the question is not just, can AI beat the market? The question is, can you use AI without letting it do your thinking for you? Can you use it to understand more, instead of blindly trusting more? Can you use it as a second set of eyes, not the final decision maker? Can you stay calm when the internet tells you the next machine is about to change everything overnight? That's the skill. Not panic, not hype, judgment. And that's really the theme here. AI may change investing. It probably already is. But, the smartest people won't be the ones who blindly trust it, and they won't be the ones who ignore it either. The smartest people will be the ones who learn what it's good at, understand where it fails, and never confuse a helpful tool with a guaranteed answer. Because when money is involved, humility matters, questions matter, patience matters. And if something sounds like a shortcut to easy wealth, maybe take a step back, maybe take 2 steps back, maybe ask if the raccoon is holding your wallet. So, can AI beat the market? Maybe sometimes. Maybe in certain situations. Maybe as part of a larger professional system. Maybe over a short period because it got lucky. Maybe in ways that disappear once everyone piles in. But should you trust AI with your money? Not blindly. Not emotionally. Not because a video said it won a trading challenge. Not because a chatbot sounded confident. not because a green line went up for 2 weeks. Use AI to get clearer. Use AI to learn faster. Use AI to organize your research. But keep your judgment, because the goal is not to turn your brain off. The goal is to build smarter. Before you go, I want to ask you something. What's one thing you think AI could actually help with in investing? And what's one thing it should never touch? Drop your answer in the comments, because I really want to see where people land on this one. And remember, this is not financial advice. It's a reminder to stay curious, stay careful, and never let hype make decisions for you. That's how you build smarter.